Good afternoon and welcome to webinar number 4 of our back to school webinars. Glad to see everybody here. I'm going to probably pander for a couple of minutes here to see if we get some more attendees here. And my associate Dan is going to be just a little bit late. So I'm going to ask to let me know that you can hear me and that you can see the screen. I'm going to be quiet for a minute or two, and then we'll get started. Looking forward to having a good and productive webinar today. And again, welcome everyone. All right, I'm sure Dan will join us when he is available. So why don't we go ahead and jump in and get started. If you do have questions along the way, please don't hesitate to put them in the question section or in the chat section. We'll be monitoring both. I see some friendly faces here, some names I know, some names I don't know. We're looking forward to hopefully making a difference in your trading. There's so many technical patterns, it would probably take us weeks to get through them all. We're going to just take a look at a few of our favorites. And as always, we have to get started by introducing ourselves. My name is John Hoagland. I am the senior performance coach here at Top Step. I much prefer middle-aged performance coach. I think that joke might be getting a little bit old, but I still like it. But I do have more than 38 years of futures industry experience, not necessarily all of them actively trading. I started like many people did. My father was on the trading floor for 45 years. His father was a grain trader out in South Dakota, Iowa, and Nebraska for his living. So it seemed that it was in my blood that I was going to get into this. But my dad was at the Board of Trade. I went to the Mercantile Exchange. I got a job as a runner. I worked my way up. I learned about futures trading and about trading in general over a period of time. Got to know people, got my break, got a job as a proprietary trader in the S&Ps. I did that for a while, funded my own account for a while, became a filling broker in the S&Ps, did that for, I think I just lost my mic, sorry about that. Did fill paper in the S&Ps for a number of years. Until probably about 2009, as many of my friends and many traders in general were realizing that the opportunities were no longer as great on the floor as they were on screen. I had a lot of friends try to go from pit to screen and relatively unsuccessfully. I used their experience to really try and retrain myself as to what I was going to be able to use as good opportunities or good areas, or what was I going to be looking at on screen. I wasn't going to be able to see some of the information that was available to me in the trading pit. I couldn't just stand here, and I can't sit at my desk and look on my screen and see that Goldman Sachs is selling S&Ps when I was able to do that in the trading pit. There was a certain advantage to being in the trading pit that we were losing. So stepping out of the pit in 2009, I spent a year unlearning a lot of the things that I was leaning on in the trading pit and relearning what I was going to be looking for as far as opportunities are concerned on screen. So it was a whole year before I decided that I felt as though I was ready to take trades electronically and on a screen. I did have a bit of a mistrust for the technology, I'll admit that, but I'm glad that I did take that time and relearn the business on screen instead of on the trading floor. I met Michael Patak and Eddie Horn and Melissa Footlick on the trading floor back in 2010, 2011. They told me what they were doing, absolutely fell in love with it. I knew that the opportunity that I had to get into the trading industry was no longer available. There weren't going to be all the jobs that were available for support jobs on the trading floor, that you could take your time and learn in a safe place to learn how to trade. So you know, I said I have to be in on this. I had to get in on this, and I'm glad I did, because it has been a great pleasure to meet, talk to, and hopefully increase the performance of thousands of traders over the years that I've been with TopStep. Really have enjoyed every minute of it, and I'm looking forward to, you know, in some way making a difference to all of you today with this webinar. I was hoping that my associate Dan would be here by now, because it's his turn to introduce himself, but I will let him do so when he gets here. And if this is Dan, he's been around for a little while. He's a good friend and associate. We'll have him introduce himself when he gets here. I always like to include some dad wisdoms when it comes to you know, trying to help people trade, because he was essential in my ability to be able to survive in this industry for as long as I have. That's a picture of him probably in about 1960. He was an individual trader as well as the hedge manager for Ralston Purina. He was charged with Ralston Purina was a huge manufacturer of animal feeds, not to mention Czech cereals. So they sent down a bunch of variety packs of Czech cereals back in 1960 for him to hand out to his friends on the trading floor. So that's a picture of him. Cropped out of this picture is the president, the then president of the Chicago Board of Trade, coming to get his Czech cereals. One of the things that he used to tell me when I felt as though I was having a hard time, or thinking about quitting, or thinking about trading as being just too hard, was he always used to tell me, you know what, son, the hardest steel comes from the hottest forge. Sounds like a line out of a Game of Thrones, but it's true. This is a difficult thing to try and learn to do. It is not easy, and it's something that is going to test you. It is going to test your steel. You are going to put your hand on the hot stove a few times before you decide it's a bad idea. So it's the difficulty that thickens the skin, that gives you that hard edge, that helps you get through some of the harder times in trading. And it's not only at the beginning. There are times when markets change, and it strips our gears in changing what we're doing or how we're doing things. So the thing about markets is, once you have the right answer, the markets are going to change the questions. So there's always more to learn, always more to know, and there's always difficulties in futures trading. You know, you can make a million. He also used to tell me that it's easy to make money, it's easy to lose money, it's hard as hell to keep. So technical analysis. There's so many different ways to view technical analysis, so many different tools, charts, time frames. All of these things all fall under this huge umbrella of technical analysis. But at its basest, technical analysis seeks to predict price movement by examining historical data, mainly price and sometimes volume. Technical analysis has us looking for repeatable patterns. Okay, it uses historical, repeatable patterns to predict future price movement. The technical tools that we're going to be looking at today are exactly that. We're only going to be looking at a few of them. The the technical analysis and the repeatable patterns, all of which kind of fall into two buckets. One would be reversal, price moving in a direction and then price changing that direction and then heading in a new direction, or continuation, where the market is moving in a direction. There is a pattern that indicates possible continuation in that direction, and then that continuation continues. We're going to just look at a few of each of these. We're going to be looking basically in technical analysis through candlestick charts, not necessarily candlestick patterns. That is a different but helpful thing to look at. If we were to go looking through all of the different technical analysis patterns, candlestick patterns, we'd still be here next week at this time talking about it. I do have, I think, a very helpful suggestion at the end of today's webinar of a website that I think is really useful in understanding, recognizing, and being able to use technical analysis in any tool or chart or time frame that you choose to use. Richard Schabacher is the writer of a book in the early 30s called Technical Analysis and Stock Market Profits. This is a quote from him that says, "The science of chart reading is not as easy as the mere memorizing of certain patterns and pictures and recalling what they generally forecast. Any general stock chart is a combination of countless different patterns, and its accurate analysis depends on constant study, long experience, and knowledge of all the fine points, both technical and fundamental, and above all, the ability to weigh opposing indications against each other. There isn't a technique of technical analysis, whether it is technical, whether it is candlestick analysis, whether it is market profile, whether it is volume profile, that doesn't hold these same nuances as truths. There's always going to be there's always going to be contrary information to what we think and what we see. It's being able to do the work, recognize the opportunity, choose the nuance that seems to be most important in the current market state to make the decision to take the trade in or not take the trade, and even in what direction we do take the trade. Technical analysis at times can be less about science and more about art. In addition, pattern recognition can be and is open to interpretation, which can be, of course, subject to personal biases. How often do you hear somebody talking about technical analysis, talking about how subjective and how the human brain tends to discount information, even if it's clearly written on a chart, how the human mind can discount information that is contrary to what it has already decided as direction for the marketplace. Analysis of markets is very large and very subjective. This presentation in no way attempts to cover all types of market analysis, nor does it guarantee the success or failure of anyone. It is meant to be an introduction to some and perhaps a review to others. Again, the subject of technical analysis is huge and vast. It takes lots of time, lots of study to really get a good grasp of what all the information is telling us. I don't know that anybody ever gets all the information. So this webinar is not intended to give you all of the information. It is not intended to impress the professionals. It's not intended to confuse the new people and in trading. It's just a basic look of technical analysis and a few of the patterns. So some of the basics in technical analysis is going to be largely market state related. When we talk about market state, most people are going to probably agree that there are two main market states. Those market states are going to be non-trend or consolidation, where we can see price just kind of rotates from high to low between two relatively stable levels, okay? Then there's trending or directional markets, where price moves in a direction relatively stably over time. We can see this market just keeps putting in lower highs and lower lows. This is a market that is trending to the downside until it isn't. Until it isn't. So there's basic support and resistance levels that a lot of traders use. This is and can be a large part of the basis of a trading strategy. There are companies that have made a lot of money trying to teach people how to recognize support and resistance. Sometimes they would call it supply and demand levels. But in support and resistance, the market looks at previous highs and previous lows as possible execution levels for trades. Here we have a market that trades up to this level. It breaks out of that level, trades higher, comes back. What was resistance, in other words, price had a hard time getting through this initially, here, and here, finally breaks out. What was resistance then becomes support. Support here, support here. Failure to accept here, continuation to the upside. This swing high here, resistant here, finally breaks to the upside here. So support and resistance, you can use kind of known pivot levels. There are pivot levels that are available on just about any platform that are going to give you a pivot level and support 1, support 2, support 3. Those are very simple tools a lot of traders look at, but it doesn't mean that they are not useful at the right time and in the correct context.
Hi, John.
Hey, Dan.
I made it.
You're here.
I am here. Sorry. Didn't want to interrupt you there. I just wanted to let you know I was able to get in here.
Awesome. Glad you're here.
And I wanted to just ask you, can you buy a couple down here at this price for me in the Dow right now?
Can I buy a couple for you?
Yeah, looking at your chart here, I wouldn't mind being long at 18,000 in the Dow.
Oh, no, right. Right, yeah. Well, look at the date here, where this is December 2016. We're using some old charts here. Yeah, this would be a really sweet move, right?
Yeah, I think I'd be retired.
All right. So Dan, I want to give you a chance to introduce yourself.
Oh, thanks, John. Hey, everybody, I'm Dan Hodgman. I am one of the performance coaches over here at Top Step Trader. I've been in the industry since day one. Literally, my dad left the hospital after counting all 10 fingers and toes to get back down on the floor. Markets broke the day I was born. So ever since I was a little kid, I was checking trades and running around the floor. Then I started clerking on the floor. And I kind of got into the trading world as a hedger. I was hedging options. I was trading the future side for a team of options traders. From there, I started managing my own options book and also maintaining my own futures account. I was in the 30-year options pit, and then I moved into the office where I started trading yield spreads and learning how to chart and trade behind the screen, because as we all know, the world was going away from pit trading. I did that for a while, went and joined the Marine Corps. While in the Marine Corps, I decided to maintain my futures account. I kept trading, a little less active, but still pretty consistently. Came back from the Marine Corps, went back to the trading firms. Worked there until 2017. That's when I came over here to Top Step Trader. And I've been working with our traders ever since.
It's good to know that your dad took care of the important stuff first, made sure you were okay, and then ran down to.
Well, back in the 80s, you couldn't check it on your phone. You couldn't trade from home. You had to be down there.
No, you had to be
Um,
there. That's right.
the family joke is I used to walk around, and my father's name is Dan as well. And every time he picked up a phone, it was calling to check what bonds are. So as a little kid, my mom always jokes my first words were me putting my hand up to my face and going, Dan Hodgman, what are bonds?
All right. Well, glad to have you here, Dan.
Glad I could make it.
Yeah. So one of the things that you mentioned there was you were up in the office learning how to read charts. That's what we're starting to look at today.
The toughest thing in trading.
Yes, absolutely. So we've gone through the two basic market states where we're just kind of looking at support and resistance. Looking at swing highs, swing lows. Uh, there are people that actually have strategies based on largely just that, and it's that of course, it's time frame based. We're looking at a daily chart here, but it doesn't matter if this is a daily chart or a 5-minute chart. The swing highs and swing lows are visual levels that traders look to.
Absolutely. John,
All
you and
right,
I talk about them all the time.
absolutely, yeah. I mean, they're one thing, ladies and gentlemen, that you have to remember is, and we kind of talked about this and on the opening of this, trading and recognizing opportunity is maybe more about art or visual than it is technical. So keeping an eye on swing highs, swing lows for support and resistance levels. Again, people have built entire strategies around support and resistance. Trend lines. Dan, you want to talk about trend lines for a second?
Absolutely. If there's one thing I enjoy, it's when a market is telling me where it's going to go. When we look at markets, like John kind of said, there's two things it can do. It can consolidate and kind of stay in a pretty tight range, or it can pick a direction, higher or lower. When looking at trends, one way to determine the trend is strictly by the visual. But really what we're looking for is our lows. In this case, we're trending lower. So we're looking for our lows to get lower and our highs to stay lower. And in this case, really, there's a couple opportunities when you're looking at these types of trades or these types of markets. First off, you can short kind of the high side as we get to the high side. And let me back it up really quick. John has the channel kind of drawn on here, which is really helpful to understand where to execute. Just like John said, whether you're looking at this on a daily, an hourly, a 30-minute chart, truthfully, as long as you trade it consistently, looking with the consistent lens, you can trade them the exact same way. And so here, when we are working on these trend lowers, we're looking for right places to enter, right? Because there are a lot of times where the market starts to bounce and it's like, okay, is this going to be a reversal or are we still maintaining this trend to the downside? Our job as traders, especially in the day trading world, is not to pick tops or pick bottoms. We want to take advantage of the directional move. As they say all the time, trend is our friend. And so if we're trending lower, what are we looking for to get in on that trade to maintain an asymmetric opportunity? Well, in this case, we're looking for those strengths where the market starts to pull back, comes to the high side of that channel. And then from there, that's where we're looking to get into that trending trade. It's not going to work every time, but if you manage that risk and you maintain consistency in what you're doing over time, in theory, it should work out for you.
Thanks, Dan. And typically, when you're drawing trend lines, and these are kind of loosely drawn, you're looking to get basically three relatively close points of contact. Here you see one point of contact, relatively close, good point of contact. This to me says this trend, as long as we stay below here, I'm going to be selling strength against this line. It accelerates at one point. We get 3 points of contact down here. I'm still thinking that this move to the downside is healthy because we're taking points of contact off this trend line and the market is bouncing off of it. Until we break out above it, I'm going to be looking to sell strength against this trend line. The next opportunity for us to look for a short after this breakout is on the upper trend line on this contact right here. So the market state accelerated to the downside, but it didn't necessarily break the bigger picture. This was such a nice opportunity to look for a short against this upper trend line. And then once it breaks, of course, now we're in a new market state. Now we're likely to either fall into range or turn around, or if we put together a continuation pattern, we're going to, we may continue to the move to the downside. Now, a couple of things in this trend, there are shorter time frame technical formations in here. The trend is to the downside. This much we can see with our own eyes. When we have a contrary move, a series of bars that are short, indecisive, and in the opposite direction, this creates what's called a bear flag. When the bottom line of the bear flag is penetrated, it's another opportunity to catch a short to the downside. Here is another bear flag. This one's pretty long. We've got a line here. We've got a line here. Once the lower line of the bear flag is penetrated and accepted below, then we've got the game on again for continuation to the downside. There are 1, 2, 3, perhaps 4, perhaps 5 bear flags. A market moving in one direction can't move in that direction consistently, and it would be nice if we could sell it here and have the market drop right to our profit target down here. But there's going to be the pullbacks. So these bear flags offer new opportunities when the bear flag, the bottom of the bear flag, is penetrated. Those, let me go back and say, these bear flags would be continuation patterns, not reversal patterns. Continuation pattern. The thing about it is, you don't know until it breaks. This could end up being a reversal pattern, but the moment that the market accepts below the bear flag, the continuation of it continues to the downside. That's the thing. Everything is subjective, and it doesn't seem like things happen the same way twice. This is a reversal pattern, and it doesn't matter whether it's at the bottom or the top. Some people would call this a W pattern. If it were a reversal at the high side, some people might call it an M pattern. But a double bottom is basically market moves to a level, bounces off that level, comes back, retests that level, does not accept below it, and then we get a continuation move to the upside. For this to be a true reversal double bottom, the market has to be in a longer term trend down to this level, bounce, another bounce, and then we continue in a new move to the upside. When do we know 100% if this double bottom is indeed a double bottom? If we wait for confirmation, we are going to lose trade location. If you're expecting a possible reversal off of this trend line, you're going to want to work this trend line as a risk limiter. Number one, yes, price does get through it. it never really accepts. There is not one candle or bar that closes below this level. That's going to give me confidence to say this is looking like rejection or excess below that previous swing low. This looks like something that may end up being a double bottom. But if I'm going to wait for confirmation, instead of buying here, I'm buying over here or over here. That is only going to increase the risk if the double bottom fails, and you're going to get your best trade location on the first or second attempt to accept below that level. Dan, do you like double bottom and double top reversals?
No, they're tough.
Me either.
They're tough. The only time I look, for me, if it's telling me it's trying to fight a trend, I have a really hard time, because at that point I'm trying to say I'm picking a bottom. When I'm looking for these, I'm actually waiting. They're going to become a level for me down the road when the market gets back towards those prices. Then I'm looking for opportunity towards or at those levels.
All right. Head and shoulders.
The classic.
This is a good example of it too.
Perfect. Looks
Very
just like you,
symmetrical.
John.
What's that?
Said it looks just like you.
Yeah, right. It's too hairy. I'm more bald than that. So the head and shoulders is a reversal pattern. And again, you can have a upside reverse head and shoulders pattern or a upside down reversal pattern. This particular pattern is a reversal from prices lower. For it to be a true head and shoulders, the market is going to have to move up to this level. You're going to have a left shoulder. You're going to create a neckline right here. The neckline is going to be kind of critical in proving the continuation of the head and shoulders pattern. From the neckline to the top of the head is a profit target that we're going to look at here in just a minute. Shoulder, head, shoulder. When this line breaks the neckline, this measured move from here to here becomes your profit target from here down to here. Don't think we quite made it on this crop of this head and shoulders pattern, but I think you get the idea. From the bottom of the neck to the head of the shoulder is when the head and shoulders proves to be true, and you get your move to the downside. That is your measured move. You measure your profit target from where you got in to where your profit target is from the beginning of the neck to the top of the head. Did you know that?
John, that was actually a new lesson for me. I've never heard that before.
So how often you see a head and shoulders? Probably not that often. But
right.
When you see it, it's going to give you that confidence, I think, to take a look and say, all right, if once we break this neckline, this is going to be my profit target. Watch and see. If you're watching it on a daily chart, you're not going to see it that often. If you're seeing reversals like a head and shoulders in a shorter time frame, you may run into it a little bit more often, of course.
Yeah, I think it's a good thing to keep in the repertoire as you do see these patterns aligning, because I think a lot of times, like we've talked in the past few weeks, getting in the trade is usually pretty easy. We've got that planned out, but where we're getting out, that's becomes one of the more difficult things. And to have a defined profit target when looking at something like this, if we have that defined profit target, it helps us accept that trade, it helps us stay in that trade, and it helps us lock in profits when we are in profits on that trade.
All right. I want to ask everybody that's listening, answer this question. What's the most important thing about a profit target? Just go ahead and type it in. All right, the descending triangle. I do like these. I like the triangle, the triangle opportunities. The descending triangle has a pretty constant bottom. Okay, we see that there's a low here, we see a low here, we see a low here. We also see that while our lows are consistent and relatively even, our highs are consistently lower. Once we break out the bottom of here, you can see that there's a pretty decent opportunity possibly to the bottom. Again, it all depends on acceptance. When we accept down below this level, you're going to see a pretty much bigger move to the downside here. The descending triangle is something I look for on a daily basis in some of the trades that I take. There are also ascending triangles. To me, the triangles can be either a reversal pattern or a continuation pattern. We don't see what happens before that in this particular explanation, but I find that if the market comes down to this, starts a descending triangle, it can be a continuation pattern. If the market comes up to this, comes into a descending triangle, it can be a reversal pattern. The one thing about triangle patterns is once you get about 75% into or 75% close to the apex of the triangle, your probabilities of a breakout and continuation multiply. Once you start getting close to the apex of the triangle, again, your probabilities of a successful breakout multiply. Here's
It's
a
almost like a
symmetrical
little spring. That spring continues to get compressed and compressed. Eventually, it has to release.
100%. What I don't remember is what happened here on this bar. Boy, there was a really big spike back up to the top there. Oh, that would have been a pretty sweet short there, wouldn't you agree?
Without a doubt. Comes to it to
Hey,
the tick and it breaks down nicely for you as you have everything set up. It's hard not to execute.
yeah, if I'm buying the Dow down at 17,000 for you, would you sell me that tick right there?
Yes, sure.
This one was, it was in 2017. At that time, I was doing kind of daily and weekly classes on futures trading in the Squawk Radio. Those of you that have been with us a while might remember the Squawk Radio and our good friend Eddie Horn. Like 11 o'clock, I think, just about every day, we would talk about some of the basics of futures. And through the week, we got consistently more deeper into more important and more complicated information. This was one of the things that I was looking at that time. And this symmetrical triangle, this was on a weekly chart. This was not a short time frame trade. You can see this is crude oil. We were trading up above $100 a barrel back in 2017. I had been watching this symmetrical triangle for months, years, maybe a couple of years. And on this breakout right here, we had one of the biggest opportunities, I think, that I've seen. And again, this is a weekly chart. As a day trader, all this did was tell me we've got a major change in price here. We've got a whole lot of coiling and energy built up over years in this market. And if I'm going to be trading crude oil, I'm not buying breaks. I'm not buying strength. I am selling strength until proven wrong. And it wasn't until we got down to around 60 bucks where I said, okay, looks like we've maybe started a little bit of a double bottom here. There's that double bottom we were looking at. maybe I should start thinking about maybe not looking to sell strength, but this was one heck of a move to the downside, and it was all tipped off by the symmetrical triangle. Here's a rising triangle. Again, the rising triangle, you have relatively consistent highs. You have higher lows with relative consistency. Again, we kind of broke out of this, maybe even 80% to the apex of the triangle, but while it was resistance, it held support before actually driving to the upside. Again, this can be a reversal, or if you ask me, it can be a continuation. The market comes up to this, forms the triangle, and continues to the upside. Market comes down, forms this, and continues to the upside. Just about any of these patterns, without a few of them, can be reversal or continuation. Gaps. If you watch the market forecast, we're always looking for the gaps, the regular trading hour gaps. Gaps occurring within previous balance tend to be closed quickly. Here's a gap. Here's previous balance. Open, close, open. We open with a gap. That tends to be closed relatively early. A gap away from current balance has a much less probability of being closed. It's important information when we are looking for a breakout of a range area. If the market opens up and leaves a gap away from a range area, there's much less probability of closing that gap. Now, we look at this on a daily basis on the market forecast as short time frame inventory adjustment or short time frame positioning that we can use against our direct competitors. This is a little bit of a longer time frame look at this. When you do have a day time frame gap that's not filled relatively quickly, it again reduces the probability of filling the gap. So when the market opens with a gap and it can't close relatively early, you look for opportunities in the direction of the gap. Dan, I know you are a fan of the gap.
I am. John, I was just going to put it out there for those listening. When you're talking about this gap here, are you looking at the entire, are all the sessions, or is this particular to regular trading hours?
Regular trading hours only. Regular trading hours only.
Yep, just wanted to clarify that for everyone.
Yep.
John is a big fan of focusing on that regular trading hour period, and it really does help when looking for these gaps and trying to execute on them.
Yeah. If you were to kind of follow the whole 23-hour continuum over the whole week, it's gonna be very difficult for any gaps to be created.
Exactly.
Gaps created from movement in the overnight, which is important. But when you think about it, Dan and everybody, the regular trading hour session is where the vast majority of the participants are available and executing. I trust the information from the regular trading hours more than I trust the information from the overnight. One of the things that the gap allows is an island top or an island bottom. This is a day time frame, a daily chart reversal pattern. When we gap lower to a range, even if it's only one day, and then we gap higher, that leaves an island bottom. The island bottom can be an extremely powerful reversal signal. We gap lower, even if it's one day, even if it's a series of days. If we gap higher, we never close the gaps. That's an extremely powerful buy signal if it's at the bottom, sell signal if it's at the top. I didn't make this chart up. This island bottom created this 3-day move to the upside in crude oil in 2017 that took it from, let's just say, roughly $55 to $63.50, an $8.50 move in 3 days. Very powerful reversal signal. Again, you're only going to see this on a regular trading hour only chart. Giving away some trade secrets here. So I want you all to take a look and write this down. Just check out stock school.stockcharts.com, or what is it called? Hang on a second. Maybe I can get the URL here for you. Chart School. Well, here. I'm going to put this in the chat room. Hopefully you guys can pick this up. It's one of my favorite sites to just basically learn the basics about technical analysis, different chart types, different ways to look at the markets. There's some really good examples of technical patterns. They do a very good job of looking at candlestick patterns. For us to go through all the information on this, again, we would be here still in a week, and I know we all have things that we want to do. So what kind of questions do we have?
John, we got a couple. I'll just start going through them here from the top.
I'm
Hoagland.
gonna put this up there too. You can get 25% off your trading combine, whether it's brand new or not, today till midnight. Market 25. That's the promo code. Sorry about that, Dan. Go for it. I'm just going to leave that up there.
Awesome. Thanks, John. Dan, how do you adjust pattern entries in high volatility markets? Today I was swept on a 3360 entry at 10:40 a.m. Sweep invalidates my entry for a second chance position at that level according to my strategy. Well, level 2, the first thing I'm going to say, what's the price we've been talking about? Just a little bit above there, 3380. I know you got a good short up there, but as we enter into these my side here, when we're entering into volatility, I'm looking for these higher time frame levels. I'm looking for confirmation before getting into things. I know strategy says one thing. Without a doubt, I totally understand that, but I definitely am trying to slow the picture down. So I'm getting to a higher time frame. I'm looking at levels and prices that hold over a longer period of time before I'm thinking about any sort of execution.
Agreed, Dan. I've been through some highly volatile markets in my day. I wasn't trading in '87, but I was a clerk, and it was one of the scariest days. And I've been through some highly volatile kind of adjustments in the market, let's say. The first 2 times I was trading, I thought I needed to be fast. I needed to be quick. I needed to get in. I needed to get out. And my outcome was terrible. When it comes to volatility, like Dan says, I slow down. I make sure that I find good trade locations in longer time frames, not just in shorter time frames. Now, was today necessarily highly volatile to where I would have made that adjustment? Maybe not. But the first thing that happens usually when volatility strikes quickly is it strips everybody's gears. So to be prepared for it, you're going to have to be anticipatory. If that's a word, is anticipatory a word?
It's a word today.
I just made that up. I'm going to be in Webster's dictionary soon. So volatility, it proposes challenges, especially, when it first hits, people aren't used to it. I don't know if that's going to help you that much level two, but what else we got here?
So we just got one from Steven. Are you guys going to offer an options combine? Nothing in the works at this point, but always considering stuff. Jean Dominique asks, bear flags and bull flags are lines you have to build yourself. Yeah, I will just jump on this here, Gene. All those lines that John had in these chart examples, he had to draw every one of those. You got to start to kind of define your own charting based off of what you're looking at. I can't think of any sort of indicators out there that will draw any patterns like that for you, unless I'm wrong, John.
No, I've never seen one. I've never
Maybe
seen one.
that's something we have to design, is a program that draws out chart patterns.
I know that there are on NinjaTrader, there you can have candlestick patterns pointed out to you. Like, if there's a bullish engulfing pattern, it'll say, hey, bullish engulfing pattern. It'll put
Okay.
it right on there. But I've never seen anything that would necessarily automatically draw technical analysis lines. It's kind of an interesting idea and an interesting concept. But bear flags, remember, you're already in a move. The market is directional. The bear flag is an opposite move with narrow or just kind of again, narrow ranges that are contrary to the bigger move. Once you are able to distinguish kind of a contrary, almost trend opposite the bigger trend, when the lower part of it on a bear flag breaks, that's your signal to go ahead and start looking for shorts again. Opposite for bull flags, markets moving lower. Markets moving higher, you get a contrary move, several bars, narrow range. Once you break the high of that upper line, that's your opportunity to look for the continuation.
Well said,
All right.
John. Sean, reasonable. He just says reasonable in comparison to risk. I assume we were just talking about a reasonable profit target, and I would assume the answer to this would be yes. I guess I'd need more information on the question.
To me, to me, my dog's attacking me. I'm sorry. To me, the most important thing about a profit target is that it gets hit.
Yep. John, here's a good one for you. What is the most common technical pattern for day trading on a 30-minute time frame, since there's only 13 candles for regular trading hours?
Wasn't that a movie, 13 Candles?
16 candles.
um,
Long duck dong.
yes. Automobile. Uh, Boy, that's a good question. It's not a lot of bars for building technical patterns. I mean, the 30-minute chart is what I focus on. But usually what I'm looking for is that 13 candle period to be showing me something in a longer time frame that is proving true. So it may not be looking for distinct technical patterns on the 30-minute chart, but I'm looking for the information in the 30-minute chart to verify something I'm seeing in a longer time frame, if that makes sense.
Mm-hmm. Yeah, I think just to simplify what you're saying there, John, you kind of define the pattern on the higher time frames, and then confirmation is created on the
In the
lower time frames for entry and execution.
Absolutely, absolutely. And there are times when you're going to get 4 or 5 30-minute candles that are largely range bound, and a breakout of that might offer an opportunity. So I would have to say, just short time frame range bound to trend, or from trend to short time frame range bound.
Mm-hmm. We're getting a little close on time here, so we'll get through as many of these as possible. Does symmetrical triangle always suggest a breakout to the downside, or could it mean a breakout to the upside as well?
This is a great question, and thanks for asking it. It depends on who you ask. You're going to have different websites tell you different things. A symmetrical triangle can be a breakout to either direction, if you ask me. Symmetrical
Same.
triangle is a coiling that says this market is preparing for a move one way or the other. Be ready.
Yeah, well said, John. What's your time frame for filling the gap relatively quickly?
See, it's another great question. It's subjective. It depends a little bit more on longer time frame context. Um, it depends again on whether the market is largely short time frame controlled or longer time frame controlled. But I'm going to go out on a limb here, and I'm going to say if we can't close the gap in the first 2 hours of trade, the probability of it getting filled decreases just out of time. So, I would have to be, Mark, we'd have to look at a particular situation, take a look at the gap, think about the condition of the market, how good of a job it's doing in doing what it's trying to do to really come up with, more of a defined hypothesis. But I'm going with, if we can't close a gap within a couple of hours, that's enough time. Nothing again is finite in trading. We can trade above and close a gap in the last 30 minutes. I've seen it happen. It does happen. What we're talking about here is probability. So if we can't close a gap within 2 hours, I'm thinking there's a pretty low probability of us doing that. Problem is waiting for that. We may miss the opportunity to the upside. So anytime you see an opportunity that you can limit your risk that is in the direction of the bigger time frame, you have to take that trade. And again, we're always thinking of limiting risk. Limit risk, because if you wait for confirmation, it's going to cost you in trade location. It's the innovators that get the great trade location. It's the innovators that pick the lows and pick the highs. I've never been able to do it, but if the low is already in and it gives me an opportunity to trade near that, I may be able to join the innovators on the second shot. But again, within 2 hours, I think that's plenty of time to try and fill a gap in most cases, and again, depending on the larger context of things.
Well said, John.
Thank you.
Well, I think we're getting to the point where we got to start cutting it off. But I do want to say, if you do have questions you want answered, you can always join John and I on the market forecast recap every day at 8 a.m. Central Time and 3 p.m. Central Time. So any questions that we haven't been able to get to you over this series, please don't hesitate to join us on YouTube at 8 a.m. and 3 p.m. Central Time every day. We're live and willing to answer as many questions as we possibly can.
And hopefully in being there with us, some of the questions we're going to answer for you over time as it is. Of course, we love you to say hello. We love to have the questions, and we love to try and answer them. So please join us. Market forecast, market recap. Also on Wednesdays, there's the group coaching at 1 o'clock where we do take a little bit deeper look at some of these questions. And thank you for joining us today.
Thanks, John.
Thank you, Dan. And thanks to all of you. Trade well, everyone. This is to your success.